What's up guys, Ben here and welcome to Motivation to Invest. We live in unprecedented times with stay-at-home super stocks skyrocketing, some by over 1,000%. But then simultaneously we have many of these tech stocks having a major correction. So the question is, which stocks will skyrocket post-pandemic? Well, in this video we're going to find out as I reveal my top 3 stay-at-home super stocks which I believe will continue to skyrocket post-pandemic. I'm going to deep dive into the business model, the numbers, and the valuation. So if you're ready for that, let's dive in. Welcome back guys to Motivation to Invest. If you're new around here and you want investment tips and exclusive stock picks, which I personally am investing into, then feel free to subscribe to this channel and turn that notification bell on. That way you'll get notified when a great stock is at a great price and I'm buying shares in it. With that being said, let's get into it. Kicking things off at stock number 3 is EA, or Electronic Arts. This gaming company has partnerships with many of the major sporting brands, from Premier League football clubs to the UFC and even the NFL. Popular games of theirs include FIFA, Apex Legends. They've even got partnerships with Star Wars, Maiden NFL, UFC, and many, many more. According to Mordor Intelligence, the global gaming market is expected to grow at a compounded annual growth rate of 917%, with their fastest growing market in Latin America and their largest market in the Asia Pacific. So there's a major growth trend in the gaming industry, and this was accelerated by the stay-at-home forces put in place. But that's not all. There are other major growth catalysts for the gaming industry. Both Sony and Microsoft are releasing new versions of their gaming consoles, which are expected to be with us by the 2020 holiday season. Using history as a guide, the launch of the PS4 and Xbox One in 2013 turned out to be enormously beneficial for EA. The stock more than tripled between the end of the calendar year 2012 and 2014, fueled by strong growth in EA's digital sales, including live services and mobile games. But that's not the only growth catalyst. In October, EA announced a partnership with Steam, the widely used PC game stores that offer EA Access subscriptions to Steam users. EA also launched EA Access on PlayStation 4. This is the part of the company's grand strategy, as CEO Andrew Wilson explained during the second quarter earnings call, to reach more platforms in the near future. Then of course there's cloud gaming, the next generation of gaming services. This will allow gamers to play big budget titles, typically reserved for consoles, on any device, which will naturally expand the audience for gaming significantly. When the technology is ready, EA should be well positioned with Project Atlas. As cloud gaming continues to develop through Project Atlas, we are testing games streamed on public cloud infrastructure to ensure we are at the forefront of this developing space, the CEO told analysts during a recent earnings call. And there's even more growth catalysts for the gaming industry. With the up-and-coming rollout of 5G, this is expected to accelerate the cloud gaming industry. Analysts expect the market for cloud gaming to grow 30% per year through 2025. So we've established the gaming industry as a great place to be for momentum investors. And with EA perfectly poised to take advantage of these opportunities, it's a great stock. But there's more. It also has a fair valuation relative to its peers. As you can see, Activision Blizzard has a price to free cash flow of around 31.43. Take-Two Interactive is 20.43 and Electronic Arts is 22.28. Diving into the numbers for Electronic Arts, I'm here on Stockopedia. Now, many of you guys always ask me, say, Ben, which platform do I use to research stocks? So here it is, Stockopedia. I use this to research stocks, as every stock is given a stock rank and it makes it really easy to investigate and analyze these stocks before investing into them. So if you're interested in the platform and you wish to try it out, I've actually got an exclusive 25% off discount link. I'll leave that below, and it's exclusive only for the viewers of Motivation to Invest. So if you wish to try out the platform and see if it fits your investing style, then feel free use the link below and sign up. That being said, let's get into these numbers. So here we are, Electronic Arts. It's got a quality rank of 96, momentum of 92, value of 45. Now we've established, as far as the gaming industry is concerned, this is actually one of the better value plays in the gaming industry. But as it's in the stay-at-home technology space, the valuation is still quite high, as would be expected from a momentum play. Looking at the revenues, we can see it's had a 4% compound annual growth rate over the past few years, but at 8% on the operating profit and a 28% on the net profit. That's a compound annual growth rate average over the past few years. The revenue is forecasted to increase for 2021 and 2022 to over $6 billion. Net income is forecasted to decline slightly for 2021-2022 for some reason, and is earnings per share. Let's check out the analyst consensus. We can see we've got 11 hold, 15 buy, and 6 a strong buy. So none of these analysts from these major investment firms, you've got Credit Suisse, you've got Goldman Sachs, have said that Electronic Arts is a sell, which is a great sign. The earnings per share compound annual growth rate is actually 49%, which is incredible. Current ratio, wow, 2.61. That is incredible. So the current ratio, for those of you that don't know, is your short-term cash to your short-term debt or short-term liabilities. So basically you want to see that the business has enough cash on hand to cover its short-term debts. That's those due within 1 year. Generally, I look for companies with at least 1.5 to 2. For example, a business with a current ratio of 2 means it has enough cash on hand to cover its debts at least twice. EA has a current ratio of 2.61, which means this company is extremely unlikely to go bankrupt and has plenty of cash on hand to expand. Checking out the share price of EA, thanks to the tech correction, it's actually just $126 per share. Yes, the stock is up by around 50% since its March lows, but this is a much lower increase compared to some of the other stay-at-home tech stocks. To me, this suggests that there's less volatility in the stock, thus I believe anything below $126 is a fair valuation for EA, given the number of growth catalysts. But remember guys, this is not financial advice, so please do your own research and don't invest any money which you can't afford to lose. If you guys are finding this video valuable so far, then feel free to give it a big thumbs up. That really helps out with the YouTube algorithm, which pushes this video to more people. And to stock number 2, and that is Crowdstrike, ticker symbol CRWD. With many people working from home and some businesses even deciding to permanently work from home, this makes their network even more vulnerable to cybersecurity threats. And this is where Crowdstrike can help out. The global cybersecurity market stood at $112 billion in 2019 and is projected to reach $281.74 billion by 2027, exhibiting a compounding annual growth rate of 12.6% during the forecast period from 2020 to 2027. That is according to Fortune Business Insights. Crowdstrike is a cybersecurity technology company based in Sunnyvale, California. It provides endpoint security, threat intelligence, and cyber attack response services. Diving into their investor presentation, we can see their mission is to stop breaches. Plain and simple. Crowdstrike at a glance, $791 million annual recurring revenue, 87% year-on-year growth, wow, 93% subscription revenue. So businesses which have a subscription type business model with recurring revenue are very beneficial to investors, as their customers are a lot more sticky and tend to stay with their current provider, and you get that constant influx of recurring revenue. 89% subscription revenue year-on-year growth, 7,230 subscription customers. Other security products are expensive, complex, and ineffective. As you can see, US patent number here, kernel level security agent. If a business has useful patents, this can give them a competitive advantage as it acts as a moat around the business. Their cloud scale AI also takes advantage of big data, as their AI technology actually gets smarter the more data it consumes. 49 of the Fortune 100 use their services, 11 of the top 20 banks, and 40 of the top global 100 companies. So these guys really are the best in the business at cyber security. You can see some testimonials here by Mercedes. We've got some on Virgin Hyperloop, Pokemon, and even the state of Wyoming uses their services. They're also getting into the Internet of Things space and the connected technology, because as we move towards the Internet of Things, and that is when everything is connected by a network. You can have your smart TV connected to your smart kettle, connected to your smart curtains, connected to your smart car. So with all this connectivity, this adds a major threat from hackers, and this is where Crowdstrike has room to grow as a business. So one platform for all workloads, from workstations to servers, data centers, cloud, mobile, Internet of Things, and containers. So with a 5-year compound annual growth rate on connected devices, which is an industry measure. They also have extremely strong customer retention and expansion. Their gross margins have been improving, which is the beauty of software services, because once you have the platform built and the support set up, when you get extra customers, it really does help your margins massively. Diving into the numbers, we're here on Stockopedia. Crowdstrike Holdings Incorporated, quality 77, momentum 99, value of just 6. Now, just off the bat, guys, this is not a value stock. Stock rank of 66. This is a pure momentum play. The stock, just to show you guys, the stock has actually increased already by over 280% since its March low. So if you would have invested in March 2020, you would have tripled your money easily in that short space of time. But the business still has a lot of room to grow, as the market cap is still relatively small at just $27 billion for the addressable market, which is over $100 billion. Total revenue. Now, this is why this company has such a poor valuation and such momentum behind it. It's this growth rate on the revenue. So usually I consider a company to be a growth company if it has a growth rate of at least 20%. Crowdstrike has 109% compound annual growth rate on the revenue. Yes, the numbers are still small, but it's growing massively. So they're predicted to reach $1 billion in revenue for 2022. Of course, with many of these type of growth stocks, they have been unprofitable year to date. However, they are forecasted to bring in a profit of around $14 million in 2021. This is because they reinvest all their money into expanding the operations. Diving into the analyst consensus, 5 hold, 12 buy, and 4 a strong buy. So there's a lot of exuberance behind the stock. There's a lot of enthusiasm. Current ratio, another fantastic current ratio, 2.18, plenty of cash on hand to cover its debts. P ratio, now this one is definitely not for value investors. 748, wow, blows my mind, but that's these type of stocks, these type of growth stocks, momentum plays. You've just got to know that if you're investing into this stock, that's the type of investment you're doing. And finally, stock number 1 on my list is Zoom Video Communications, ticker symbol ZM. With the majority of businesses working from home and many pledging to continue to do so in the future, second wave or not, then Zoom Video Communications could be a great stock. This year, Zoom Video Communications has seen its stock run up by over 200%. However, recently, due to the tech pullback and some issues of security threats or Zoom bombings, the stock has now pulled back slightly. So could this be a great opportunity to invest into it? And what about all the competitors? What about Google Meet and Skype from the big tech giants? Zoom is a video conferencing tool which allows you to virtually meet with others. Zoom was originally a niche service used by enterprise clients, half of the Fortune 500 reportedly. However, these days, Zoom now has over 300 million users. However, the rapid growth caused some slight scaling issues, mostly in the form of Zoom bombing, which is what happens when participants join a Zoom meeting uninvited and broadcast content. Zoom recently issued a big update to help curb the security issue. Zoom's free plan offers unlimited one-to-one meetings, 40-minute limit on group meetings, and online support. You can share your screen, collaborate, people can virtually put their hand up and get involved in different meetings. This is why Zoom has been so popular with its customers. So what about its competitors? What about Google Meet and Microsoft Skype? Well, although they have great video conferencing tools, Zoom still feels like the favorite option for many people. If you're a G Suite user, then Google Meet is probably your better alternative, especially for business. And the same goes for Microsoft. If you're a Microsoft 365 user and wish to collaborate using their tools, then Microsoft Teams is probably your best option. But apart from those cases, Zoom is one of the most innovative, easy to use and cost-effective platforms out there. Zoom's that easy to use that it even allows you to set up webinars and access their platform without even making an account. Diving into the numbers for Zoom, we're here on Stockopedia. Zoom Video Communications, quality 93, momentum 99, value of just 4. Now, this is not a value stock. This is another exuberant momentum play, a true growth stock. Stock rank overall, 75. Total revenue, wow. Compound annual growth rate on the revenue, as I mentioned previously, around 20% I consider a growth stock. 117% compound annual growth rate on the revenue, which is why the stock has shot up massively. For example, in 2019, the revenue was just $331 million. But for 2021, it's predicted to increase to $2.4 billion, which is incredible growth. Operating profits currently at $220 million. Her revenues forecast to increase for 2021-2022, earnings per share and net income all forecasted to increase. Analyst consensus, 15 hold, 1 sell, 4 buy, 8 a strong buy. We've got people here from Morgan Stanley, Credit Suisse, JP Morgan. Current ratio, 1.73. So generally I look for a current ratio of at least 1.5, 1.73 is okay. Valuation P ratio of 141, price to book 90, price to sales 80. This is not a value stock, pure play, momentum and growth. So overall, Electronic Arts, Crowdstrike and Zoom are 3 fantastic stay-at-home stocks, which I think will continue to grow well into the future. If you wish to invest into those stocks and get the up-to-date knowledge on how they're performing, then I suggest you sign up to eToro. This is a free investing platform which is a partner with this channel. The unique thing about eToro is it's a social trading platform where you can actually copy successful traders' trades and portfolios. Diving into the platform, you can see here, if I go onto the Electronic Arts stock, I can click trade. I can simply buy the stock or sell the stock for completely free, or I can trade the stock using leverage, CFD trades. Of course, there'll be a small charge for that, as all brokers will charge for that. But then you've got the social trading, so people put their comments about the stock. For example, someone said here about the new Xbox Series X, which is going to be launched, which all helps to build an investment thesis for potentially investing into a stock. Copy portfolios, copy traders, and you've even got a pure gaming portfolio which you can invest directly into. So that's eToro. If you do want to check it out and see if it fits your investing style, then I've got a free link which you guys can use in the description below. If you sign up to eToro and you deposit at least, I believe, $1,000, the channel will get a small bit of commission at no extra cost to you, which does help with running the channel. With that being said, what are your thoughts on the 3 stocks I mentioned, and do you think they will continue to skyrocket in the future? Comment your thoughts below and I'll join in the discussion. And if you enjoyed this video and found some value, then feel free to give it a big thumbs up. That really helps out with the YouTube algorithm, which allows me to create more great content like this for you guys. In addition, if you want more investing tips and exclusive stock market picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, I'll see you guys in the next video. Invest safe.